Some mathematicians use their skills to make money in the stock market. They find patterns and use logic to try to predict what will happen next. But the market is tricky. Even smart people can get it wrong. Sir Isaac Newton, the genius who discovered gravity, lost a fortune in the stock market. He said, "I can calculate the motion of heavenly bodies, but not the madness of people." This shows that even with math, the market is unpredictable, but other mathematicians have done very well. Edward Thorpe and Jim Simons used their math skills to beat the market and make a lot of money. They show that math can be a powerful tool for investing. Their stories are fascinating and show how math can be used in unexpected ways. Edward Thorpe was a math professor. He was good at finding patterns and using logic. In the 1960s, he used his math skills to beat the casinos at blackjack. He invented a system called card counting. This system helped him predict which cards were coming next. He wrote a book about it called Beat the Dealer. Casinos were not happy. They tried to stop him, but Thorpe's system worked. Thorpe then turned his attention to the stock market. He saw similarities between casinos and the market. Both involved probabilities and trying to predict the future. He used his math skills to develop investment strategies. He made a lot of money for himself and his investors. His success showed that math could be used to beat the market. Jim Simons is another mathematician who conquered Wall Street. He's known as the Quant King. He started a company called Renaissance Technologies. This company uses complex mathematical models to make investment decisions. Simons hired mathematicians, physicists, and computer scientists. They created algorithms to analyze huge amounts of data. These algorithms find patterns and predict market movements. Renaissance Technologies has been incredibly successful. Their flagship fund, Medallion, has generated huge returns for decades. Simons and his team prove that math can be a powerful tool in finance. Sir Isaac Newton was a brilliant scientist, but even he couldn't predict the madness of the South Sea bubble. In the 1720s, the South Sea Company was a hot stock. Everyone was buying it. The price kept going up. Newton bought some shares. He made a profit and was happy. But then he got greedy. He bought more shares at a much higher price. The bubble burst. The stock price crashed. Newton lost a fortune. He famously said, "I can calculate the motion of heavenly bodies, but not the madness of people." This experience shows that even with math, emotions and human behavior can be unpredictable. Section 5. The mathematical arsenal of a stock market guru. Mathematicians use many tools to analyze the stock market. These tools help them make sense of the data and find patterns. Probability is a big one. It helps investors understand the likelihood of different outcomes. By looking at historical data, they can calculate the chances of a stock going up or down. This information helps them make informed decisions. Statistics is another important tool. It helps investors summarize and analyze large amounts of data. They can calculate averages, trends, and correlations. This information helps them identify patterns and make predictions. Section 6. Probability, playing the odds. Probability is the study of chance. It helps us understand how likely something is to happen. In the stock market, probability is used to assess risk and potential reward. For example, let's say a stock has a 60% chance of going up and a 40% chance of going down. An investor can use this information to decide if the potential reward is worth the risk. Of course, these are just probabilities. The actual outcome could be different, but by understanding the odds, investors can make more informed decisions. Section 7. Statistics, unveiling hidden patterns. Statistics is all about collecting, organizing, and analyzing data. In the stock market, there is a lot of data to analyze: stock prices, trading volume, economic indicators, and company news. Mathematicians use statistics to find patterns and trends in this data. For example, they might look at how a stock price has moved in the past. They might compare it to other stocks in the same industry. They might look for correlations with economic data. By analyzing the data, they can identify potential investment opportunities. Section 8. Modeling the market, a mathematical approach. Mathematical models are simplified representations of the real world. In finance, these models are used to simulate market behavior and make predictions. One popular type of model is the stochastic model. These models incorporate randomness and probability to simulate the unpredictable nature of the market. By running simulations, investors can test different scenarios and see how their investments might perform. Section 9, the human element, the X factor in the equation. While math is a powerful tool for investing, it's important to remember the human element. Emotions play a big role in the market. Fear and greed can drive prices up or down. Even the best mathematical models cannot perfectly predict human behavior. That's why it's crucial for investors to be aware of their own emotions. They need to be disciplined and stick to their strategies, and they need to be prepared for the unexpected.